uncomfortable truths about poor loan setup, which has homeowners and investors stuck. So we speak with a lot of people, and often what they're looking for is two things: better interest rates on their home and investment loans, and second, the ability to tap into the equity to be able to move further. But what they find is they're often stuck because of poor loan structures which don't enable them to be able to build that wealth over the long term.
Yeah, and some of the most common things that we find people stuck with are cross-collateralization. So cross-collateralization is where a number of two or more properties have been tied together. So more often than not, people have not been explained the risks associated with this structure. And imagine when it comes time for you to sell one property, the bank will really have you jump through hoops for you to be able to do that. So we helped a client and restructure their home and investment loan, and they were cross-collateralized between the two properties. And the first thing they said to me was, well, we had a friend who actually sold a property which was cross-collateralized, and the bank had the first dibs at the profit because the other property that was tied with this property was worth less than what they had paid for. So basically, the bank has the first rights to your equity, any profits that you have. So it is high risk.
And also, I heard this recently that apparently bankers or lending managers at bank branches are actually encouraged to tie properties together just so that the bank retains control. So that way the bank has the revenue for the long term from you, and you're really literally stuck, and you just really have to rely on them. That's right. And the second mistake that people make, or that keeps people stuck, is having the incorrect repayment types. So do you go for interest only loans? Do you go for principal and interest? Is this your home you're talking about, or your investment property that you're talking about?
Yeah, and look, there's nothing wrong with going one path versus the other. It's just what meets your needs and your goals.
That's right. And having the correct payment types can shave off years of your owner-occupied debt.
And we recently helped a client restructure their loan, so they were able to actually save $30,000 in tax as a result of just switching around the repayments type.
Yeah, that's a third thing that people get into is mixing their tax deductible and non-deductible debt. So mixing their owner-occupied loans with their investment loans and not realizing how they should be kept separately and set up correctly. So you pay off your home loan first and then pay off your investment properties. And of course, responsible lending is you paying off all your debts and all your assets off. However, what do you prioritize? Tax deductible debt or non-deductible debt? And for that, you need good advice.
I hope you found this useful, and we look forward to speaking with you soon.